Hello and welcome to New Wave, your go-to resource about climate investing in Europe. Today is a very special episode as I've gathered a crew of LP to talk about how to raise a climate fund in Europe. Joining me today are Jan, investor at Aurum Impact, Bas, investment director at Carbon Equity, and Anniken, investor at Ferd Impact. Before we jump in, don't forget to subscribe on YouTube, to follow on Spotify and Apple Podcasts, or to sign up to the newsletter to get episodes directly in your inbox every Friday. All right, let's get into it. A very special episode today. Super happy to have an LP panel, which is quite unusual. Usually I talk to GPs, but this time I'm going in a different direction with LPs to talk about climate funds. I'd like to ask everyone to introduce themselves and a little bit of what they do in their firm. Anniken, ladies first. Do you like to say a few words about Ferd?
So Ferd is a family office based in Oslo, Norway, managing the fortune of the fifth and the sixth generation of the Andresen family. So we do a bunch of different investment activities, but I'm focusing on climate investments, early stage, investing into funds from pre-seed to growth across Europe and North America. And then we also try to do some co-investments together with the fund managers that we are invested in.
Cool. So I'm an investment director at Carbon Equity. We're basically a climate investment platform where we run multiple strategies, but our flagship program is a fund of funds spanning from like really early stage up until late stage and buyout funds investing in the US and Europe, and then doubling down via our co-investment program in some of the later stage emerging winners. And then next to that, we also have an infrastructure fund of fund program.
My name's Jan. I'm part of the investment team at Aurum Impact. We are part of a German family office by the Goldberg family with a background in construction. We invest impact first into startups directly and into funds, which is today's focus. We make fund investments from early stage, pre-seed to growth venture capital, both in Europe and North America.
Well, look, let's get started with the topic of the day. I guess the first topic I'd like to cover is on how to evaluate climate fund, what goes into your diligence process. Anniken, if we start with you, how do you go from like probably, 500, 600 funds that apply to your program to all the way down to a few investments per year? What goes into that selection?
We try to start a little bit, bottom-up, mapping out the full landscape of climate funds out there. And across Europe and North America, the universe is actually not that big, so we can have a quite good overview of all the funds. So we start by actually this year we started sending out a survey, trying to be more structured in the way we reach out to the funds to get some like basic information about the different funds, reading their presentations, and then we take calls with most of them. I think also it's a good thing just to meet the people. It's really a key part of the investment criteria is the people behind the fund. So talking to them and gradually trying to get it down into the funnel to a long list and then to a short list. And I think talking about the evaluation investment criteria is a big topic in itself. We have a quite comprehensive scorecard where we try to be a bit objective, comparing apples to apples across the funds. But I think it comes down to, I guess, three quite important dimension. One is the team. What are their backgrounds and why are they making this fund with this strategy at this point in time? There needs to be sort of a common thread behind the strategy and what they do. I think it's track record. For most European climate funds, it's hard to look at the track record. Most of them are on their fund 1, 2, or 3. So we don't have too much data to look into. And then the third quite important pillar is references. So we talk to a lot of people when we hear good words about fund managers from different angles. I think that's a good testament that people like them and like to work with them, both across funders and co-investors. So that's quite high level. At least 3 important pillars that we look at.
Does that look like the same for you guys, Jan and Bas? Do you have the same type of process? Because I haven't heard before of someone sending out forms to GPs to collect them and meet with everyone, right?
I like it. We should do the same, Anniken. But I think it's relatively similar, right? Like, so I spent a long time as well as Wiebo at our investment team at Alp Invest, where we invested in a lot of funds, right? So you have kind of the standard framework where you look at team strategy, governance, references, whatsoever, right? And you obviously apply that to investing in climate funds as well. I think the trickier thing is twofold. It's more of an emerging market, right? There's not the luxury of CVC 12 or index, whatever they're now, 14. But it's also, how do you assess a climate fund? And I think that's kind of the secret sauce we've been developing here and refining over the years at Carbon Equity as well, and learning along the way and speaking to great co-LPs like Ferd or Aurum. But it's really, for us, a top-down and bottom-up analysis of what are they going after? What is their thesis? What is the theory of change per investment? Like, what is their expertise? How is kind of, reaching climate impact also embedded into their processes? And a really bottom-up analysis where we look at every investment that's been made in the prior funds and maybe in the current fund or pipeline, where at least we try to map every investment to see if it can be substantial contributors to our transition to net zero, or that they have some impact or other, right, adaptation or biodiversity. So really the top down and bottom up, and now at least funds are moving to fund 2 and 3. There's more track record from a climate perspective to analyze, like the type of assets they're going after, the bottom up analysis, what type of assets they've been going after, and what is kind of their role in the energy transition, is playing an increasingly bigger role than more like top down. What is your strategy? What is your vision? So it's a evolving landscape, but that makes our work also more interesting.
I'd agree with both Bas and Anniken. In fact, we actually do send out a questionnaire or a survey as well to collect all the information in a structured way. We did about at 150 funds last year. And then the process itself is fairly similar. What's most important to us at the North Star is having teams who want to focus on environmental and social impact, sort of above everything else, and then develop a strategy surrounding that with the right sort of team, previous experience, and focus to fund investments.
And one question, maybe to the three of you, but we probably all get a lot of messages every day. Your inbox is probably full at the end of the day, LinkedIn, whatever. Like, it's, there's so much information available today, but then equally it's super hard to reach people because they get thousands of messages per day. How do we get a meeting with you? Like, what's the best way to get a meeting with any of you?
I think the most powerful ones are always via other climate funds, right? If there's a climate fund we have invested with, we trust, and, they try to ask, hey, one of my friends or ex-colleagues works at this climate fund. Are you interested in taking a meeting? That's the easiest way to get on the meeting calendar here. Cold outreach works. It's not ideal. We go to a lot of conferences and it's easy to meet us there. I think that also works as well, as long as you start with a a nice introduction instead of like full on your name and then immediately pitch your fund. That's always a bit of a harassment.
True. I think intros help. We attend lots of events too, for example, Super Climate. Next one will be at Slush in November. But we do look at all the funds interested in investment from us, and all funds can apply through the survey that we have on our website. And it's I think just generally fundraising is good to build relations and do that early on. So we get to know the teams over a period of time.
Yeah, and just a question on that. Have you ever invested in a fund that came through a form on the website?
Good question. I think we've had funds coming in both ways, through the form and then in addition through an introduction, so both at the same time. And we've invested in such funds.
Adding to that a bit, I think coming in from different angles is probably a good thing. One thing is sending in an email, and I actually read my emails, so I see everything in my inbox. So if I don't want to have a meeting, it's not because I haven't seen it, but because I don't think that's the relevant to have that meeting. But if I see that email, then I go to a conference and speak to some people. I get a reference to another channel, then suddenly I have a couple of data points on that fund manager, and then it probably makes more sense to to take a meeting. So I think trying to be a bit creative to put it on top of my brain from different angles is probably a good thing. I think also don't be so sort of too eager. I think it's a lot of the same we look for that GPs look for when they invest into startups. And I think if you're nagging too much, being too pushy, then that's probably a turn off for most GPs, and it works a little bit similar for us as well. When we have established a contact, we know that you are there, and if you need more info, then usually we will reach out. And of course, it's good to get sort of an update, like once every 6 months or 12 months, if there are like interesting new milestones or things that has happened. But apart from that, I think we can also reach out when we feel like we are ready to talk.
I think that's a relevant point, right? Like getting the meeting is one thing, but there are enough emerging climate managers out there, right? If you're not on our radar and you kind of emerge on our radar, like to get the meeting, you also should offer something differentiating, right? And I think there's plenty of funds already out there. It's super tough to raise capital, but if you come with a differentiating strategy, team, or setup, or for some reason you've been flying under the radar and you're now raising your fund 3 with DPI and fund 1, right? Like that gets you the meeting, of course. But yeah, just another 150 million first time climate fund in Europe going after seed series A. I think it's also tough to get meetings with new LPs. It's not the easiest strategy to raise capital for.
True. We're especially looking for funds that go into other stages, so very early stage or growth stage, and then also underinvested themes such as natural ecosystems. That's what we're interested in at the moment.
I was about to ask, actually, what gets your attention? Because obviously, okay, great. Like I've sent an email, Anniken reads every single email she gets, so perfect. She'll read what I sent, right? But what should be in that email? And also, I guess today, what gets your attention? Because obviously, as you said, Bas, I mean, if it feels like all of the same, and it's again a new fund with the same strategy and same stage of investment, it might not get you excited as much, right? So, what gets your attention today, and what should be part of that first connection point that I have with you, I guess?
I think it's back to Bas' points that you need to differentiate in some way, and maybe also do your homework. So you need to read up on the LP you're reaching out to, try to make yourself relevant or build a story of why is it relevant for us to invest. And I think also it's a little bit about spending your time wisely, figuring out who are the most relevant LPs. So if you're looking for an anchor, a lot of LPs don't take that role, so don't spend too much time on talking to LPs that are not relevant. I think it's good to take a call early on anyways, to sort of start building a relationship, but spend most of the time on the relevant LPs. And I think also being like a small emerging climate manager, you should maybe start in your local market. We get a lot of emails from, one example, like German climate funds do a lot of German or planning to invest into Germany, and they have good local relationships, etc. But it's really hard for us to figure out if that's a good setup. So I think on the contrast, if there's a Norwegian new setup doing climate investments, it's easier for us we know the people, we can easily get more references, we know the Norwegian company, so then it's easier for us to do an exception and actually invest, even though they don't have the longest track record. So I think it's actually about research on the LPs, spend your time wisely on the ones that have the mandate to actually invest.
Going back to what you were saying, what's a good LP GP fit then? Because obviously you, as you said, like you want to reach out to the right LPs to make sure that they're also interested by your fund.
I think it depends. For us, what we want to achieve is great financial returns and strong climate impact. So if you can merge the two, and if you have like a long track record, then it's definitely a good fit for us, independent of where you're located. But I feel the challenge is when you don't have the track record, you haven't really proven the strategy, then you need to be a bit more creative to find the ones that are willing to sort of take a bet on you and give you a big leap of faith. And then that's where I'm thinking it's actually probably a good idea to go to more local investors, because it's easier for them to be to really understand your strategy, your backgrounds, and want to support. Maybe they can go bit down on the financial return if they feel like they have strong impact in their sort of local community or and they want to support innovation in the country in general. But I mean, if you have a strong track record and a climate strategy, then I think that's a fit for most of us around the table.
Do you feel like GPs are prepared enough when they come to pitch you today? Like, do they consider enough the person in front of them? Or would you say that most of them just come bluntly at every LPs with the same arguments?
I feel the latter a lot, to be honest. I think a lot of, especially, so there's also a big difference if you're pitching to like a general LP that also does a bit of climate, and you have certain LPs like, I guess the three of us, which are fully focused on climate. And then you have happens more often that you have more like these generalist type of funds and are also raising their climate vehicle, and they're just doing the same they've done before. They start with team track record instead of like, no, we try to understand what type of climate investment you're going after, right? And if we really see, okay, that fits with our strategy, let's then discuss kind of your track record or the team and the setup. And I think a lot of managers just use the same story for everyone. Well, you should definitely cater to your audience, and there are some generalist LPs who just don't care about the type of impact. They just see a huge investment opportunity in the energy transition. It's great. Let's also have them invest in these funds, right? We need them. But when you talk to climate LPs, you should start somewhere else and really explain what you're going after.
I agree. Impact should be first, and then speaking about returns after, as opposed to the other way around. We're looking for both, but impact is center stage. We want to see a clear impact mission, the right framework, a theory of change, a measurement approach, and also how then that is integrated into the portfolio once the fund starts investing. And that was actually one of the common decline reasons that we had where we did not invest into funds, that the impact was not explained well enough for what we were looking for. And then on the other hand, geography and stage, what Bas said, sort of seed series A in Europe is something that we have in the portfolio already. So we're looking to broaden in other themes, but also stages.
Do I understand correctly that basically our climate or impact is a filtering criteria? So it's like a yes or no, and then you go down the funnel to the other things. But if you don't have this, like if it doesn't match from a climate or impact perspective, it's a yes or no already, right?
Yes. I mean, we have 9 investment criteria overall. We have them on our website, and we do a yearly webinar as well to speak about the fund investment process and become more transparent. So we do look at all of the 9. For example, we're also interested in the GP team, how diverse it is and how complementary the backgrounds are. But impact is a central theme that's sort of important across the evaluation.
I also feel sometimes, to be honest, for climate GPs, it's so tough, right? Because you want to cater to, LPs and it for the returns. And then you have like a different shade of like impact LPs, right? That some demand impact reporting, others are relaxed about it. So it's also not easy, right? Like clearly Jan also prefers other things than we would do, which is totally fine, right? But there's also a different spectrum of climate LPs. So it's also a nuanced story. And that's why trying to understand who you have in front of you, like, give another LP or GP a call, like what's important to Ferd, right? Like, for instance, we obviously think impact reporting is important, but it's not a requirement to get capital from us. We invest a lot in the US. SFDR reporting is not really a thing there. So we're more flexible on it as long as we kind of align on what type of assets you're going after. But for other LPs, it's super important. So if you can understand that upfront, you know what to focus on in the first conversation without, boring people with topics they don't care about.
Let's try and get some insight as to what they get, like what do GPs get wrong usually and what do they get right? Because I think the goal of that conversation is to try and find the best advice we can from the three of you to make sure that more GPs come to you more prepared and that you do more investments. That's kind of the idea, right? So what do GPs get wrong usually about in that first meeting that would push you away from investing, I guess?
I'd say what we're looking for is a team fit, portfolio evidence, and the impact approach in the first meeting. So that should be the main themes. And then, of course, as Bas said, it makes sense to really think about who you're speaking with and then tailor your pitch to that type of LP, because in the end, you want to have a different sort of number and categories of LPs in your fund. And then it makes sense to speak individually to those categories of LPs and understand what they're looking for.
For me, a few things are important, right? Obviously, there are a lot of like standard things, but I'm looking for a conversation on the pitch, right? If it's just like 45 minutes without them hearing you trying to ask a question in the interim, right? Like really make it a conversation. And for me, it's the start of a relationship, right? And that start with that first meeting. So having a proper conversation, but also honest one, like obviously you made mistakes, right? Or maybe you paid up somewhere, and like showing a bit of honesty just builds a lot of trust with me. So I don't know, be commercially honest, right? Like be excited about what you're doing and show the upsides in some of your assets, but also share what you've learned or what you want to do differently. Or when you talk about fundraising, it's also super tough market, but don't try to bullshit. Just be commercially honest. I think it's a nice way to build trust.
Yeah, I think echoing a lot of that. And then also in the end, it's a little bit about your gut feel. I don't like to say it, but it's a people business. So it's also, do you feel like you get the trust, feel like they are transparent? And then also, I agree, a good conversation. I think we have a lot of meetings where the fund manager is talking all the time. We don't really get to ask for questions. And that's okay, I guess. It's not a red flag, but I think we will get more out of the meeting if we could have like a good discussion. So adding a little bit, I think we are invested into PrailBlue. Hampus and the team. I think Hampus has been on the podcast previously, and they told us when they started the fundraising, they sent out this top reasons not to invest into PrailBlue. So they are focusing on climate funds, they do pre-seed, seed, and a lot of other things. So just to get the filter in, if you're not interested, then that's fine. If you're still interested after seeing all these reasons not to invest, then we are happy to take a call. I think it's also it's a cool way to do it. Try to just figure out who are actually the relevant LPs, and then we take the conversation with them. And then you know that at least there are a couple of things that you have on your list to present that they would be interested to hear more about.
Yeah, that's best advice to the maximum, which is like sending a list of commercially honest points about why not to invest in a fund. I like that. Well, I guess to switch to another topic a little bit, but how do you, as a GP, build an edge or like a unique selling points to, I guess, be different and be interesting for LPs?
I think now we actually start to see a bit like a split in the market, because I guess the teams have progressed from Fund 1 to Fund 2 and maybe to Fund 3. You can actually look back to see what did they say in the beginning and what have they actually delivered on. So I think that's sort of a way to differentiate if you have actually really delivered on what you said to begin with. And then there's also this other thing. So I think in 2020, 2021, a lot of new climate funds came in. And I think some of them did it because they genuinely thought climate is a big problem we need to solve, and we believe it's the biggest business opportunity of our lifetime. I think a couple of other funds did it because they thought there's a lot of pools of money from LPs wanting to invest into climate. If we make a climate strategy, then it will be easier to raise capital. Now the sentiment around climate is slightly different. I think a lot of the tourists are out of the space, and now you really have a lot of the ones that are at least committed to climate. So the heat is a bit smaller. Some of the climate funds that were tourists are moving more towards AI, dual use, resiliency, defense. But the ones that actually stick to the underlying thesis, that's also a small differentiator these days. Apart from that, it's extremely hard. I think the team composition and the people is, I guess, that's the easiest way to differentiate. But having a stellar complementary team that have achieved a lot prior to starting the fund.
I agree, but I also struggle with that group that came into climate really for the right reasons, right? But they also just went after big impact problems, kind of hoping the financial opportunity would just come along. And I think we're going to see a lot of differentiation in those funds over the coming years as kind of those portfolios might be struggling a bit more, right? Obviously, the sentiment was different 4 years ago and to get financing for certain type of assets. But at least we deploy a lot in the US as well. And there was and is a big difference in kind of the rationale for them to be investing into the asset. I think in the US, a lot of investors have been investing in the energy transition for a longer time because they just see the opportunity there. And at some point, they just also put the climate label on top of it just to get capital a bit more easy. While in Europe, it's the other way around. And I do also really much like those funds that go after it, also because of the economic opportunity, but invest in strategy, right? And then if they label it climate or resilience or whatever these days, as long as they invest in the right assets and they're also in it for the kill, I love it, right? Let's go after it. And I think in Europe, there are too many funds that started in 2020, 2021 that were maybe too much focusing on impact and underestimating that it's tough to scale or that the best technology most efficient technology is not per se the winner. There are a lot of things that need to come together, and so that financially motivated teams with the right strategy are something we like a lot as well.
Yeah, it's a very good point. And just a quick comment to that. I think also when we're talking about it now, we're splitting it into two, financial return and impact. But I think the most powerful is when you don't need to talk about either or, you talk about them integrated because you're addressing this big business opportunity. And by coincidence, that means investing into climate companies that are solving this river problem.
Is there ever conflicts on your side between return and financial return and impact, or is there one that goes above the other in the checklist?
I think I can speak for our side. So we want to prove that we can do climate impact with market rate returns. So we don't want to sacrifice return for impact, and we need to find another case where we feel like we can do both. But still, I think it's TBD if we are able to achieve it. We started 6 years ago. VC fund timeline is 10 plus 2 years. But I think in practice is closer to 15 or 18 years before we get the money back. And historically, a lot of the outlier companies has been within more software, fintech, all the social platforms. So we also believe that a significantly bigger proportion of outlier companies in the future will be climate companies, and that will make us successful. But time will show.
Francis, this is a balancing act, right? Where we're building these fund of funds, and for certain commitments, there's just a lot more comfort in the financial returns because you're talking about established managers that have a track record, launching their third fund, where probably to Anniken's point, they either come together, right? Impact and return, you don't need to really separate them, or at least that from the return perspective, there's such a strong team, there are strong investment partners, right? And on the impact side, because they've been doing it for a while, it's reasonable to expect that they will continue to do the same type of deals that are in scope for us. But if we're doing early stage, deep tech, climate in Europe, we're taking a lot more risk on the financial side. It's just more unproven. It's a tough market. So when we build portfolios, we also add a couple managers where we know on the impact side, this is really, really high, but on the financial side, we take a bit more risk. But if it works out, we get rewarded for it, right?
No.
And then there are other managers where we feel clearly stronger on the financial side, and we take a bit more risk that they might, go off strategy with one or two deals where we can question, is this really going to move the needle? And I think in the end, you just need to construct a good portfolio to show that you can do both. Because if all these climate fund portfolios are not going to return decent returns, there won't be a lot of money going to these funds anyway thereafter.
Jan, is that your same perspective on the topic, or do you prioritize impact more?
Generally, yes. We like to see impact and financial return within the portfolio. We we're flexible in how we construct the portfolio, especially if there's underinvested themes like social impact or natural ecosystems. And we don't need to max out sort of each percentage point of IRR. If there's a good strategy and that matches the team's previous expertise and industry network, then it's also fine if the target return is a bit lower than for standard funds, as long as it's still targeting a return. And in that overall portfolio, we can do a good mix of topics.
Well, something else that you've mentioned already. Let's be quick on this topic because I don't want it to be the main topic. But resilience, dual use, climate, whatever the buzzwords, right? Do you guys care at all? Like, is that are we just all working on branding, and is that really important, or is that just a label that we put on the deck and that doesn't matter?
To us, it doesn't matter. Like for us, it matters if your strategy is not shifting, right? You're going still after the same type of assets. And obviously, if your fund started 4 years ago and there are now new investment teams showing up, obviously you can do different type of deals, right? That's totally fine. I do think it's important to a lot of LPs, especially in the US, to get them on board, as they cannot do climate anymore, or they feel it's too narrow, or whatever of the gazillion reasons I could come up with. And if you can mobilize that capital by giving it a different label while still doing the same, I think it's totally fine. If your fund is going to do 100% dual use, kind of semi-defense, I think it's tough to still find the same type of LPs. But if you're a couple of your portfolio companies can also get another revenue stream to scale up your company with, defensive type of defense contracts, we're relatively relaxed about it. But as long as the underlying exposure for us doesn't change, it's just marketing.
Well, I agree. As long as it's not a strategy drift, I think it's fine, and it's probably also a good idea. The world is changing, and the fund managers need to adapt, but stick to the underlying thesis and then adjust to what's happening in the world. I think also we see some of these more older climate funds. A lot of them have, I guess, good strategies for 10 years ago, but they don't change their impact approach. They stick to sort of their core thesis from back in the days, and I think it's good that you actually have a good thesis underlying, but then at the same time you also need to adapt to a changing world. So it's a fine balance, but I think to be applicable for the US LP landscape, and also to show that you are following what's happening in the market, I think it's good.
I think it's also fair to some extent, and maybe people in Europe don't fully realize it, but like the whole AI boom and the hyperscaler build out, what we're seeing in our US portfolio, like companies that we labeled climate, and you can label them AI or whatever these days now, they're just really flying. And it's great, right, that you can think a lot about the hyperscalers and have different opinions, but at least they're amazing customers to buy some of the products or be like a first client to try out emerging technologies, right? Like geothermal, or like next generation geothermal. Geothermal is obviously not emerging in itself. So making that point clear that climate is broader than just taking, going after CO2 emissions and just green out. Like the whole AI boom in the US is not going to be there if we don't have enough power.
Something else you quickly talked about, Anniken, that I want to react to is obviously climate is a new topic, I would say, in the VC landscape. It probably emerged 5-6 years ago. I guess for most of you, you have started 4 to 6 years ago. Are you optimistic about what the portfolio right now in terms of the returns? And really the reason why I ask this question is, should more LPs do the same? Like traditional LPs, can we encourage them to also look at these topics a bit closer?
I'm actually super positive. I think the tourists have left the space, but the ones that are committed, they are almost doubling down. And there are some really good underlying drivers from AI and data centers that triggering a huge demand for energy. And I think that's better than any regulation or policy to help get down the cost curves of renewable energy technologies. And also went to the US for New York Climate Week, and I was a bit skeptic to how was sort of the sentiment and what's happening there. But I think also that it's the same over there. The ones that are committed to climate, they are really doubling down and maybe rebranding slightly what they're doing, but it's the same. So I think we need more more investors into climate, and I think we need more investors into VC. So maybe that's sort of the most important part from a European perspective, at least, that we want, I guess, more pension funds, etc., to put money into VC. We are really lagging behind the US when it comes to the proportion of VC in the pension.
I'm also very excited, and we see some really strong companies emerge in our portfolio, but it's also an easy market to make mistakes. And if I look at a lot of family offices or whatever local pension funds, they just invest in their country. They pick some local VC funds, typically a lot of early stage exposure, and I think it can easily go wrong. So I think it's a super exciting asset class, but you need to build a bit of expertise and clearly a diversified portfolio. And for us, a diversified portfolio really also means US exposure, despite whatever is happening in the US, despite the whole sentiment with Trump around a lot of climate technologies. The majority of the capital is there. The majority of the hyperscaler build out is there. A lot of the really proven climate fund managers that actually have a track record. Some of them are out there, and I'm a big fan, obviously, of Europe as well. And we continue to deploy here, but if you want to build a climate portfolio, don't only go early stage. Don't only invest in your own country. Like, try to build a diversified portfolio over a couple of vintages.
Exactly, just adding to that, I think that's the most important part. Build a good portfolio that gives good impact and financial return, and ideally maybe you would like to do 100% in Europe, but I think it's a better idea to do a certain proportion in the US to make sure that it's a successful setup, because there's a lot of times during history when people have sort of burned their fingers on doing venture and doing climate, and then they stays away for far too long. So it's important to do it successfully the first time now, so we can prove that this is a good strategy, and then we can be more take more risk as we go.
Agree with both. We definitely need more capital in venture, but then specifically also in impact, and not just climate, but broader environmental topics such as circularity or social. If we look at sort of this state today, I think it's early days for the funds. The funds for a couple of years just ended the investment period, and then returns will take another sort of 5, perhaps 7 years. So that said, it makes sense to build a diversified portfolio, as Bas mentioned, geography, stages, but also vintages. And taking a very long-term perspective, the money that goes into private markets is mostly institutional capital, pension money that's meant for people when they reach their pension age. And investing in such topics will actually deliver better quality of living, I believe, if you reduce the impact of climate change. That will, to some extent, decrease, or at least the damages will increase. Houses flooded, for example. And if whatever we can do through smart investments to limit that, I think it just makes sense.
Yeah, I love that. I think it's also a smart way of looking at pension funds. So we talked about the tailwinds a little bit with AI, data center, and the energy needs that we have. If we go to the sectors that are not going well, are there any particular sectors where you've seen people basically burning their fingers and not really being able to deliver value?
There are at least some sectors. I think hydrogen is probably one that's struggling a little bit. Let's see in the longer term, but I think there's a lot of companies struggling in that sector. Carbon markets is probably another one. I think there's still huge potential in direct air capture and carbon markets, but it's a little bit too much driven by voluntary long-term market and people being a bit altruistic and regulations as well. So it would take some time before we have like a well-functioning market there as well. We have a lot of investments within the offshore wind industry. We think the underlying drivers are still there, but there's definitely a down cycle at this point in time. But with VC, we can be patient. We are not expecting exits in the first 2, 3, 4, 5 years anyway. So we need to take the time. But there are definitely a lot of cyclicality in the climate space. That's challenging.
You see hype cycles go in the climate sector, right? And I think geothermal or nuclear, like some investments look amazing today, and a lot of capital is going there. So I'm sure, in 5 years, we talk about people who stepped into geothermal today, or next year. What for certain assets might be too expensive, or we've seen it in food tech. I think it's very hard to get big exits there, and there was a lot of hype around it a couple of years ago. But to compete on unit economics and actually get a big exit, right? Most corporates don't buy, billion plus type of companies for like a tug-in. So there are different pockets that get overhyped, or the economics just don't work, or the exit window is not there. And I'm sure we'll see a few new ones in a couple of years.
Pinged quite a few GPs before this episode. I was like, what do you want to know about LPs? And they were all like, what's actually going on behind the scene on due diligence? So tell me, what's the magic behind the scene? What's happening when GPs are waiting for you to answer with a yes or no, right?
Happy to go ahead. It's relatively straightforward. It's a structured process. We have the survey I mentioned. We do a screening of that. Then we go to first calls. We go into due diligence, where, for example, we dive deep into the portfolio, and if there are existing investments or previous angel investments, we conduct reference calls during due diligence, and then we get the internal investment approval for soft commitment, and then following that, there's sort of the legal DD in the signing. We want to be transparent about a process. As I said, we do a webinar once a year. We share the insights from that webinar on LinkedIn too. And then on our website, we have all the criteria that we assess. We have the full survey, and you have portfolio funds that we invested in.
And when you mentioned the technical due diligence, like looking at the portfolio companies, and like if you have only a couple of companies, or if you have no companies you've invested in, like what do you look for? Or even if you have a large portfolio, actually, because obviously still climate is a new topic, so it's hard to see a lot of exits and real DPI, right?
We look for a combination of a clear strategy that matches the team's expertise and network, and then that paired with impact. So if there's an existing portfolio, we'd like to understand the impact and the sectors the companies are active in, and of course their financial development and the subsequent rounds they were able to raise.
But there's a weird dynamic between directs and fund investments, right? But when we have a co-investment, you drop everything and you just run for 3 weeks, and then you give them a yes. And then when they come to you for a fund investment, you just take 3 months. and I think that's also a bit what's behind your question, right? So, and it also depends how fast GPs are available, right, to get you the data and do the follow-up calls. But a fund DD process is something you do in parallel with other processes. And you're also waiting for like other LPs to finish. Like the big LPs are typically the slowest. And you kind of need those bigger LPs as well to de-risk the fundraising. We don't want to step into 100 million close if the fund needs at least 300 million to build a well-diversified portfolio. And especially in the current market where fundraising is tough, fundraisers get postponed, and we're not going to say yes before we know like kind of others are also wanted to come in, or otherwise you need to give kind of a minimum threshold. So it's also a bit of a chicken and egg problem between the GP really setting a date where they know people are going to be there. So I know I need to be done by the end of September. So it's a bit of a weird process compared to directs where you just drop everything and you run.
I agree, and we talked to a lot of managers, and they are saying we will close the fund by end of year, and then we are pretty sure they will not close the fund before summer next year, because I think we always feel like we have a lot of time So also stressing us a bit, trying to get the sense of urgency, actually doing a fund close when you're planning to do it. So I think a good thing is trying to prepare before you start a fundraise. So we have a line of sight to at least the first close and a certain amount of the fund size. So you can quite quickly close a decent amount of money, then you sort of get the momentum started and people get interested because they see that others are joining. So it's a psychological aspects of it as well, trying to create a sense of urgency and show that you have good traction on the fundraising. And then at some point you just need to do the fund close, and then suddenly when you actually decide to do it, even though you don't have the line of sight, and a lot of LPs are jumping down from the fence because they feel like now they actually need to do it. I think we are a bit like on the conservative side. We're a small team. We prefer that other bigger LPs can go through the VPAs and other fund agreements before us, because we don't really have the capacity to do that. We usually want to push the decision as long as we can. Then we can see more investments in the fund before we jump in. But we're starting to see some more interesting structures where you actually get quite some good financial benefits from joining early on, like a discount on the management fee. So I think trying to be creative to create the sense of urgency. And then I also agree a lot with Jan on the aspects they're looking into, and I think we're evaluating a lot of the same. Maybe a couple of things to sort of pinpoint in addition. One is discipline. It's a little bit hard to sort of evaluate, but I think most funds make their portfolio model. So how many investments will they do? What type of ownerships are they trying to get? How much follow-on capital? And then when they model that out statistically, it's a good setup and they get good return. And then a lot of them start to drift because they get a good opportunity. They don't get the desired ownership, but it's such a good opportunity and it's a high price, but the opportunity is so good they just do it. And then they deviate from the model. And when you do that a lot, then you start to you don't have the statistics behind you, and then you actually need to be better than the market or sort of better than the index, and that's actually quite hard. So discipline is important. And another aspect going a bit under the radar is probably a governance and skin in the game. There's a lot of maybe more these platform funds where they have a bigger platform founded by some famous man or women back in the days. They was super important to begin with, but now they have spun out the platform to a bunch of different strategies and funds. But the regional founder that that is close to be retired is still in the IC, getting a certain big amount of carried. So we like that there's a lot of skin in the game and decision power in the investment teams that actually do the investments. So that's an important point as well.
I want to touch on emerging managers, but one of the questions on that is specifically, how do you get someone to commit first, or should you actually do the other way around? Because one of the questions I received from the GP is like, do you need a first big anchor, someone that puts in a big check, or would you rather do a bottom-up approach where you collect a bunch of small checks before getting the big? Like, what's a way of doing it when you're an emerging manager? Because obviously it's I think even harder to get commitments.
I think in Europe, at least, there are a lot of like government pockets, right? And especially EIF, they write humongous checks. If you look, like, relatively speaking, to the fund size. So that clearly helps, although you still need to match it with private capital and you need to raise that somewhere. Another strategy that I've seen some managers take, and I do appreciate it, that you just raise a smaller fund that doesn't necessarily have a 3 to 4 year investment period. You raise it from friends and family to just show first couple of investments, or you can anchor, if you have that type of capital, your first fund where there's actually something to look at. And then if you get EIF or KfW as some of the sovereigns, depending on which country you're based in, and match that with local family offices. They're not, as far as I know, not that many like real anchor LPs. There are a couple, all right, you can go after them. And there are a few family offices that are a bit more entrepreneurial and maybe a share of the carry, or they take an ownership stake in your management company. Yeah, again, be early with EIF if you want to raise an emerging fund in Europe. I think that's the biggest, the biggest type of capital you can get here.
I agree. Anchor investments from EIF or KfW in Europe are great to start a fund and then get additional private capital on board.
Interesting. Well, one last question on emerging managers, but how do you read the signals for emerging managers? Because obviously, as you said, like you don't have DPI, obviously, and like even deals, for some of them, they have less deals. Like these are mostly team composition. Do you need to have someone from a VC background? Does emerging manager mean former angel investor? Like what's the definition of it? So how do you read the signals?
VC background is great, at least in investment background. If you have worked at another VC firm, then that's a strong testament that you know how this works. But also in investments. I think some people start to think a couple of years before they start a fund, they want to prove to themselves that they can actually do this, that they can get access and do good investments. And I think that's also a good thing, because then it's not like spontaneously they felt like it will whip them to start a fund, but they actually think it's interesting, started to do it a bit privately, put some skin in the game, and started to prove the strategy a little bit. I think that's try to find the track record in some way, if that's angel investment or if it's previous track record from an investment role, because I think it's good that you have been on the operating side. You're probably a really good board member and good to speak with the founders, but there's also having experience and pattern recognition within investments is extremely important, and someone on the team needs to have that.
It also depends what type of venture fund we're talking about, right? Are we talking early stage or more like these growth venture funds? There, I think it's paramount that there is someone who's been doing this for a longer time, really has experience in doing the couple months type of due diligence where you go way deeper. There's a lot more to analyze, right? Like more like the traditional investment banking, private equity, VC growth type of experience where you really can go deep on the numbers. Vis-a-vis super early stage where more like a bet on founders, right, and help founders scale. There you can probably get away easier if you're more like operator type of role combined with someone with some type of VC experience. But having also like managing a larger fund or a VC fund in itself, someone there that actually has experience in how to manage an institutional fund also has a lot of value, because we see a lot of these emerging managers make mistakes of the operating side, governance, reporting, what have you, keeping not enough reserves because the market is bullish. You want to deploy more. There are like gazillion mistakes to be made, and it's nice to have people who have been around, have invested in institutionalized funds before.
I think in the end, you just need to put yourself in the shoes of an LP. I mean, if you would not invest in your strategy and your team yourself, then we would probably not do it either. So I think some people are a bit naive. They think they're just doing it because it's fun, but they don't really think if they were in our shoes, would they actually put the money in their hands. So a lot of them they are investors. They know what they look for in a startup. Just put themselves in our shoes and then try to think, what will we look for? What would make them interesting to invest in?
Well, thank you so much. It was a pleasure. I loved it.
Thank you.
Thanks for having us.